Hello and welcome to today's video. In this video, we'll try to maximize our returns by actively reallocating our portfolio to capture the market opportunities. When you buy into an asset in a capital market, you probably allocate your portfolio into stocks and mutual funds. Some of it you probably put into some bonds, and at times you have enough cash at hand. You keep enough cash at hand. Now, instead of choosing and sticking to the initial blend of the mix of portfolio that you thought of, it's wise to invest and monitor and see if they are giving you the expected returns that you have thought of. If they are, well and good. If not, you may reallocate and shift your portfolio to better fit your risk appetite, better fit for the returns that you're expecting based on your risk appetite. But how does this work? In this video, we will see just that. So like this video and subscribe this channel right away so this video can reach a lot of people. Now first, let's start off with your risk profiling. Now, if you have been to any finance portal, any investment portal, if they're really good, they would ask you for your risk profile first. They would give you a set of questions and they'll ask you to fill up, just for them to understand the kind of risk that you can take in the market. They do so just to understand what kind of risk you can take in the market so that they can recommend a portfolio mix for yourself, for the risk appetite that you can handle. But why do they do so? See, every human being, every individual, every investor has a different risk appetite. I may be prone to take on more risk. I have enough capital to expose it into the market. You may not have it. Someone else might be more prone to take on more risk than me. He or she might have enough to expose it into the market. So the amount of risk that I can take in is not the same amount of risk that you can take in. It's not probably the same amount of risk that he or she can take in. It might start to bother me if my portfolio goes down by 50%, which might not happen with that person. So it all boils down to the amount of risk or the amount of volatility that you can handle in the market. And so, to understand this personal, individual trait, we have these kind of questions that all the investment platforms, they probably go ahead and ask. Also, your risk meter is generally estimated by these factors. Number one is your age. At younger age, your risk-taking ability is at its highest. You can take on more risk because you have time in hand. But when you start growing old, probably into your 40s, 50s, just nearing your retirement, you'll find it very, very hard to take on more risk in the market because you do not have time at hand. The second most important factor is your knowledge about the market. The more you know about the market, the more you understand the market, the more you'll be willing to take on more risk. If you do not know, if you do not understand it, you'll be hesitant. You'll be frightened, you'll be terrified. The third most important point is your investable surplus, the surplus amount that you have at hand which you can invest in the market. Now, what does this mean? This means that I am comfortable to invest around 20, 30, 40, 50,000, maybe 1 lakh, maybe 5 lakh, 10 lakhs in the market. That's fine. That's my surplus. I'm comfortable putting that money at risk. He or she, the other person who can take on more risk, they can put in crores. That's their surplus. Someone who's starting off, maybe just comfortable with 5-10,000. That's it. May not be more. So it all depends on where you are, how much surplus you have in the market. Number 4, the time horizon. The amount of time you're willing to stay invested in the market. The longer you stay invested in the market, the more prone you are to take on the volatility and stabilize it to generate maximum returns. If you have short time, it will be very, very risky for you. So the time horizon of your investment is a very, very critical factor. Number 5, your investment objective. What is it that you want to achieve from the market? Do you want to keep your capital safe so that inflation doesn't eat it? You can put it in safer assets like bonds, maybe gold if it gives inflation beating returns, which can safely beat the inflation and give you a capital protection if that is what you want. And if you want capital growth, if you want to grow your capital, if you want to see your portfolio increasing, you can take on more risk. Number 6, your behavior in the market. This is very, very important. See, everything that you do in life boils down to your behavior, your psychology, your mindset. How you behave with the people, how you behave with others that you interact on a day-to-day basis, how you behave with the market would perceive how much the market is going to give back to you. How you behave with the other person would determine how the other person would behave with you. Same way, how you behave with the market would determine how the market would behave with you. What you do, how you behave in the market goes up and down when it's volatile. What do you do? Are you impulsive or are you patient? Are you freaky or are you calm and composed? Do you panic a lot or it doesn't bother you at all? All of these and many more would determine your risk appetite in the market. Now, once you have defined your risk appetite, first, let's form a strategic asset allocation for yourself. Let's try and do that. Suppose Mr. X is making a portfolio for himself. He puts some of his investments in the stock market, right? And then he puts in some into fixed income instruments, puts some into commodities, and then keeps some cash at hand, right? So let's say when he is making this portfolio for himself, his portfolio mix stands like this. He puts in 45% into the stock market. Say he is not a huge risk taker, he is of a moderate risk person, and so he is constructing a moderate risk portfolio for himself. So he puts in around 45% in the stock market, around 35% into fixed income instruments, around 20% into commodities, or maybe around say 10% in commodities, and he keeps 10% cash at hand. So this is the portfolio mix that he has prepared for himself, right? Now, during the normal market conditions, Mr. X would hold on to this allocation as it is. Then there are times when Mr. X will take active stance on the strategic allocation itself to capitalize on the market economic opportunity. Let's say the demand for a commodity is set to increase over the next 2 years. Now, this was his initial portfolio mix. What he does now is, this is before, right? Before the opportunity came in. Now, after the opportunity comes in, what he does is, this is after. Now, after the opportunity comes in, what he does is, he keeps the same 45% here, he keeps the same 35% here, he puts in the excess cash that he had at hand into the commodities. Why? Because he sees a demand for a certain commodity is set to increase over the next 2 years. So why would he have cash at hand? which is not earning good returns. Instead, he would like to capitalize that and put it into the commodity section. So eventually, he keeps the portfolio's strategic allocation same, but just allocates a little more on the looming market opportunity. He allocates his cash holdings. He does that to capitalize on the quick gains that the market opportunity has presented to him. Now, similarly, we all inferred that the market would fall sometime in 2020 because of the rising pandemic situations late in 2019. Many would have predicted, and many would not have also predicted, a huge fall in the 2008 crash, but would have definitely identified the rising phase after the crash. And similarly, so during the post-pandemic rise. Now, when you identify these moments, it's wise to shift your cash and capitalize on the gains which are about to take place. This is all about the tactical asset allocation. But hold on. What I just said, isn't that rebalancing? Well, it looks like one, but it's not exactly rebalancing. There is a very subtle difference. Rebalancing is done regardless of the opportunity and time. It is done when the actual asset allocation balance shifts. You rebalance and bring it back to the original ratio. Tactical asset allocation actually enables you to take on or forcefully disbalance your portfolio and put on more holdings into an asset which is about to take a huge plunge. It's about allocating your money into an asset which is about to take a huge leap. Tactical asset allocation is all about debalancing your portfolio, knowingly removing your allocations from different assets and putting into the one asset which is about to take on a huge leap. But how does tactical asset allocation help? But how does this help? Obviously, one, it increases your returns. It does, because you are pushing in more funds into the asset class which is about to take a huge jump. So what it does is, you saw in the first part how the average return on your portfolio is calculated. For the asset class A and B that you have calculated, if your expected return for the asset class A is more than B, the overall combined return of your portfolio increases. That's how it helps here. When you put in the majority of your asset, the majority of your fund into an asset which has the potential to give you more returns, has the potential to jump up, it gives you more returns. The returns in your portfolio increases. The expected returns of your portfolio increases. And number two, adapting to the market conditions. Tactical asset allocation responds to macroeconomic events. In the year 2000, the dot-com bubble, 2008, in 2020 crash, the stock market did not perform well. The stock market underperformed other asset classes. Now with this strategy, you can shift your allocations to other asset classes to gain or to maximize the returns while the stock market was underperforming. And number three, of course, diversification. You diversify into other asset classes which tends to give you more and give you a little push on your portfolio. So, portfolio rebalancing is necessary. It is very, very important. But what if you can tactically allocate your asset and generate more returns out of your portfolio? Wouldn't that be nice? You could always bring it back to your original ratio after rebalancing. But why not capitalize on those gains or safeguard yourself from the losses when the time comes? Why not capitalize on the gains after a post-pandemic, after a war, after a dot-com bubble, after the great crash, after anything, after a huge market dip? Wouldn't it be wise to do that? Hit the like button, subscribe this channel, and think over it. I've just given you a tasty recipe for your portfolio. See you again in part 3 of maximizing your returns. Till then, SG signing off. Goodbye.